The bin fan ran all night. Donna Schiff could hear it from the farmhouse, the low hum of the aeration system keeping the wheat dry through the October cold. 10,400 bushels of soft red winter wheat, harvested clean, sitting in steel bins on the east side of the yard waiting. The question was not whether to sell. The question was when. Donna had farmed 200 acres of winter wheat in McLean County, Illinois, for 9 seasons, the same 200 acres her father had planted every fall on their 480-acre operation before he turned the books over to her in 1978. She knew wheat. She knew her ground, knew the elevator at Bloomington, knew what a good year looked like and what a bad one cost. The 1983 harvest had been neither 52 bushels per acre on average, close to her 5-year mean, a clean crop with good protein that the elevator graded at number 2. She had 10,400 bushels in the bins. At the price the elevator was posting in early October, those bushels were worth $35,464. The question was whether they would be worth more in March. At the elevator in Bloomington that first week of October, the bid for cash wheat was $3 per bushel. The March foot, Uri's contract on the Chicago Board of Trade, was trading at $3.65. The difference between the two, the local cash price minus the futures price, was minus 24 cents. That spread was the basis. Donna's elevator manager, a careful man named Herb Walters who had worked that counter for 60 years, offered her a forward contract for March delivery at $3.41. He said it was a clean number, and the basis was tighter than it had been in recent falls. He said the market was moving on export news and that he thought wheat was going higher, but that he was in the business of offering contracts, not of telling farmers when to sell. Donna said she'd think about it. She drove home and pulled out the legal pad she kept for grain marketing decisions. Not a fancy system, just a yellow pad with columns she had been filling in for 9 years. She wrote October at the top. Then she wrote $3.41 forward. Then she wrote the questions she always wrote before deciding anything. What is the market expecting? What would change that expectation? What was it cost to wait? She had answers to the first 2. Export demand from Egypt and North Africa had been strong through the summer, and the rate was pricing and continued buying through the winter. If the dollar weakened further against European currencies, American wheat would get cheaper on world markets, and demand would likely stay elevated. The futures market was reflecting that thesis. The third question was the one she worked through, in the most detail. Commercial storage at the Bloomington elevator ran 4 cents per bushel per month, 48 cents per year. On 10,400 bushels, that was $416 per month. Her operating line at First Midwest Bank in Normal carried a balance of $38,000 at 16.5% annual interest. Every month she carried unsold grain. The interest on that line ran approximately $522. Total carrying cost per month, 938 cents. Per bushel per month, 938. Per bushel per month, 9 cents. She wrote that number and looked at it. Then she ran the break-even forward. To come out ahead of the October forward contract at 3.41, she would need the net effective price in March, cash price, minus 5 months of carrying costs, to clear 3.41 plus 0.45 cents in total carrying costs, or 3.86 cents. Put differently, March futures needed to be high enough that the local cash price in March, after the basis was applied, landed above $3.76. She wrote that number and put a box around it. The futures were at $3.65 in October. She needed the middle level that would generate a cash price above $3.86 in March, assuming the basis stayed near its current level of minus 24 cents. That meant March futures around $4.10 or higher. She thought $4.10 was possible. She thought the export picture supported it. She thought it was worth waiting to find out. What she did not write on the legal pad, because she did not yet know to write it, was a second line. What happens to this calculation if the basis widens? What does the Reach cash price looked like if futures reach $4.10, but the basis moves from minus 24 to minus 50 or 60 or 70 cents. She had the carrying cost column. She did not have the basis sensitivity column. That missing column was the whole of the problem. Here's what the basis was doing, tenths. That she could not see clearly from where she was sitting in October. The basis, the spread between Chicago futures and the local cash price at a country elevator, is not a fixed number. It moves. It reflects the local supply and demand for physical grain, the cost of transporting grain from that location to the terminal market, the availability of storage, and the behavior of commercial buyers and sellers in that specific market area. In normal conditions, basis tends to narrow as delivery approaches. The cash price converges toward the futures price as the storage premium in the futures contract gets priced out. That narrowing is part of what makes storage profitable in good years. You buy basis, in effect, when you store, and you collect the improvement as the delivery month approaches. But basis does not always narrow. In years when local supply is abundant and elevator storage is tight and commercial buyers have alternatives, South American wheat, European wheat, held by other sellers in other regions, the basis can widen instead. When basis widens, the cash price falls relative to futures. The number on the board goes up. The number on the check goes sideways, or due. Here's what happened to the McLean County wheat basis between October 1983 and March 1984. October, futures $3.65, cash 3.41 cents, basis minus 24 cents. November, the export news held and futures moved higher. March futures were trading at $3.80 by mid-November. Donna checked the Elevato, our board, and saw the cash price at $3.52. The basis had moved to minus 28 cents. She was ahead of the October forward on cash price $3.52 versus the $3.41 she had passed on, and the market was still moving. She kept the bins full. December futures $3.95, cash $3.57, basis minus $30, mini pash $3.57, basis minus 38 cents. She had been right to hold. The cash price was climbing. She had turned down $3.41 in October, and by December the cash price was $3.57, 16 cents better on 10,400 bushels, $1,664 she would not have captured if she had taken Herb's contract. The decision that had felt uncertain, Etart, in October was feeling correct in December, and that feeling was real and not irrational. The market had done what she expected. She was 11 months into her farming year, and for the first time in 3 years, the grain marketing decision felt like one that was working in her favor. She updated the column on the legal pad with the December numbers and noted that the net effective price, accounting for 2 months of carrying costs, was $3.39, still below the $3.41 October contract, but trending in the right direction. One more month of futures gains and she would be ahead of it. At the feed-s tour in Bloomington that December, a woman she knew from the County Farm Bureau asked how the wheat was sitting. Donna said she thought she'd wait for the rally to run a little further. The woman said she'd heard the same thing from 3 other producers that morning, and that everyone was watching T's same board. That observation was more important than it seemed at the time, and Donna did not register it as significant when she heard it. But the fact that 3 other producers in McLean County were also holding their wheat and also watching March futures and also waiting for the cash to fall out meant something specific about what was happening in the physical grain market. When everyone is watching the same board and waiting for the same rally, the physical grain doesn't move. When physical grain doesn't move, elevator storage fills up. When elevator storage fills up, the elevator storage fills up. The elevator can afford to widen its basis, because sellers with full bins and carrying costs running have less negotiating power than they did in October when the bins were just sealed and the options were still open. January 1984, futures 4.05s. cash 3.33, basis minus 52 cents. Donna wrote that number on the legal pad and stared at it. The futures had moved from $3.65 in October to 4 all fives in January, 40 cents higher. But her cash price had moved from $3.41 to $3.53, 12.73 towers, 12 cents higher. The basis had widened by 28 cents in 3 months. The number on the board was up 40 cents. Umber she could actually sell at was up 12. She calculated her net effective price if she sold that week. Cash $3.53 minus 3 months of carrying costs at 9 cents per month equaled $3.26. The October forward contract she had passed on was at $3.41. She was already behind it. She did not since L. She told herself the basis would tighten in February as the March delivery date approached. The way it was supposed to tighten, the way it usually did when you were close to the delivery month. She told herself the futures were still moving and that the cash would follow. February 1984. Future S $4.10, cash $3.45, basis minus 65 cents. The futures had stalled at $4.10. The cash price had actually fallen from January despite the futures holding because the basis had continued to widen. Elevator storage in McLean County was running at capacity. The commercial buyers who had been apporting export demand through the winter had slowed their buying as South American wheat began to move into the global market. The thesis that had supported the rally, sustained export demand, weak dollar, strong Northern Hemisphere buying, had not proven wrong exactly. It had proven insufficient to move the physical basis in McLean County in the direction that Donna had needed it to move. March 1984, third week. Futures $4.10, cash $3.39, basis minus 71 cents. Her operating loan renewal was due April 1st. Herb Walters called on a Tuesday and said storage capacity at the Elevado all was full and that he would need movement on our position or would have to start charging penalty storage. She sold the following Friday, 10,400 bushels at $3.39. Total proceeds, 35 through 56ths, 5 months of carrying costs on that position. Storage and operating loan interest, D run to approximately $4,690. Her net effective price after carrying costs, $35,256 minus $4,690 divided by 10,400 bushels equaled $2.94 per bushel. She put the legal pad on the desk and wrote that number at the bottom of the column that had started in October with 341. Here's what Donna had been right about, and it is worth being specific. The futures market had done what she expected. It had moved from $3.65 to $4.10, a 45-cent rally over 5 months. Her read on the export demand was broadly correct. The thesis she was using to support her decision to hold had played out in 3E futures market. Here's what Donna had been wrong about. She had been watching futures prices and thinking in futures prices and making decisions based on futures prices as though futures prices were the same as cash prices. They are not the same. They are connected by the basis, and the basis is not a fixed number. And in McLean County in the winter of 1983 and 1984, the basis moved against her by 47 cents while the futures moved in her favor by 45 cents. The net result of a 45-cent futures rally and a 47-cent basis deterioration before carrying costs, W1, as a 2-cent disadvantage. After carrying costs of 36 cents per bushel, she was 38 cents per bushel below the October forward contract she had declined. Basis is not noise. It is not a rounding error. It is a real market price that reflects the specific conditions of the specify. See market where your specific grain will be sold, and it can move independently of and opposite to the futures price that most people watch when they are deciding whether the market is going up or down. A farmer who watches futures and ignores basis is watching half the price. The number on the board is the Chicago price for wheat delivered in Chicago in March. The number on the check is the McLean County price for wheat delivered in Bloomington in March. Those two prices move together on average, but they do not move together always, and in the months when they diverge, the divergence can be large enough to erase a rally that took 5 months to develop. Donna Schiff continued farming that McLean County wheat ground for another 14 years. She did something specific after the 1984 experience that she had not done before. She started keeping a second column on the legal pad. One call, for futures prices, tracked weekly through the storage period. One column for the local cash basis tracked at the same intervals. She had always known that basis existed. She had not previously treated it as a number that required the same attention as the futures quote. After 1984, she treated it as the more important number because the futures told her what Chicago thought wheat was worth, and the basis told her what Bloomington thought it was worth, and Bloomington was where her wheat was going. She also called Herb Walters in October each year and asked him a question she had not previously thought to ask. What do you expect the basis to do between now and March, and why? Herb had been looking at local storage capacity, regional carry-in from the previous year, export loading activity at Gulf terminals, and South American harvest timing for 16 years. His basis forecast W as not always correct, but it was better than no forecast, and it was calibrated to McLean County in a way that the Chicago board was not. She forward contracted a portion of her position in October every year after 1984, not because she stopped watching the market, but because she started understanding that the forward contract's value was not just a price, but also the elimination of basis risk for the contracted portion. The October contract at 3.41 had not been a bet on where the market was going. It had been a guarantee that the basis risk was someone else's problem for that quantity. He had declined to buy that guarantee because she was focused on the futures number. The 1984 spring was the year she understood the price of that guarantee was not the spread between the contract price and where she thought futures would go. It was the spread between the contract price and where she thought futures would go. Basis would end up taking the cash price on the day she actually sold. She learned to ask what the basis was doing, not just what the board was doing. She learned that the board told her where Chicago thought wheat was worth. The basis told her where Bloomington thought wheat was worth. And Bloomington was where her grain was going to be sold. She was not wrong about the direction of the market. She was wrong about which market she was actually selling into. Have you ever sold at a price that was different from the price you thought you were selling at? Not because the market moved again. Because the number on the board and the number on your check were never quite the same thing to begin with.